Unlock the secrets behind our financial blunders. Dive into the mind's twists, turns, and the psychology driving bad money choices. Hello and welcome back to our channel. Today, we're diving deep into a topic that affects us all. Why we make bad financial choices, even when we know better. We've all heard the golden rules of finance. Spend less than you earn, save for retirement, and buy low, sell high. But somehow these seemingly straightforward principles often elude us. Join us as we explore the intriguing world of cognitive biases and emotional traps that lead us down the path of bad financial decisions. So, without any further delay, let's dive right in. What is cognitive bias? Ever wondered why financial decisions often defy logic? It all boils down to cognitive biases, mental shortcuts shaping our choices. Cognitive bias is a double-edged sword, offering quick decisions but potentially leading us astray. Take confirmation bias, where we selectively embrace information aligning with our beliefs, often blinding us to crucial details. The availability heuristic tricks us into judging situations based on easily recalled memories, potentially prompting hasty financial decisions. Anchoring bias makes us overly rely on initial information, risking overspending due to fixation on a single detail. Survivorship bias distorts our perception of success by spotlighting winners, obscuring the numerous failures. Lastly, the sunk cost fallacy forces us to invest more in something, driven by a fear of losing prior resources rather than sound judgment. Let's have a look on 5 reasons of why we make bad financial choices. Number 1, confirmation bias. Confirmation bias is like wearing glasses that only let us see what we want. Imagine choosing investments based on popular stocks. If we like a stock, we hunt for data supporting our belief, ignoring anything against it. This tunnel vision led even top private equity funds to overlook red flags in Sam Bankman-Fried's FTX crypto platform. Charmed by SBF's charisma, investors brushed off warnings and clung to positive opinions. This collective oversight resulted in a colossal $8 billion loss when FTX declared bankruptcy. In everyday terms, confirmation bias is sticking to your favorite dish on a menu, ignoring the tempting specials. It's a mental shortcut where we cherry-pick information to validate our existing beliefs while overlooking essential facts. Recognizing confirmation bias is crucial in financial decisions, ensuring we don't fall into the trap of selectively seeing what we want and instead make choices grounded in a more balanced and objective perspective. Number 2, availability heuristic. Picture this. Your mind acting like a mental shortcut superhero, making quick decisions based on readily available memories. That's the availability heuristic at play. Suppose you've heard about a stock skyrocketing recently. Your brain may convince you that all similar stocks are on a rocket ride without checking the facts. This heuristic often tricks us into thinking that what happened recently is more likely to happen again. In everyday terms, the availability heuristic is like assuming all pizzas from a new joint will be amazing because the first one you tried was fantastic. It's a mental shortcut where we judge situations based on what comes to mind easily. Being aware of this tendency helps us make more informed financial decisions, preventing us from jumping into investments without thoroughly researching and understanding the broader context. So, before you dive into the market frenzy, remind yourself that availability doesn't always equal reliability. Number 3, anchoring bias. Imagine your first piece of information acting like a magnetic anchor, pulling your decisions in a particular direction. That's the anchoring bias in action. Companies use it when slapping a 75% off sticker on a product, anchoring your perception to the initial higher price. It tricks you into feeling like you're getting a steal, even if the actual value might be much lower. Anchoring bias leads us to place disproportionate importance on that first nugget of information, blinding us to other critical factors in decision-making. In everyday terms, it's akin to a store setting a high initial price for a product, then slashing it to make you feel like you're getting a bargain. Recognizing anchoring bias is key, helping us detach from the anchor and make more rational choices, untethered from the initial information's influence. So, next time you spot a discount, question if it's a true deal or just a clever anchoring trick. Number 4, survivorship bias. Survivorship bias is like seeing only the tip of the iceberg and assuming it's the whole picture. Imagine focusing on successful entrepreneurs without considering those who didn't make it. This bias occurs when we overestimate our chances of success by only looking at the survivors, ignoring the vast number who failed. In the business world, media loves highlighting unicorn startups valued at $1 billion, creating the illusion that hitting this milestone is commonplace. Yet, for every success story, there are countless businesses that don't reach that pinnacle. It's like cheering for the lottery winner without acknowledging the millions who didn't strike gold. Survivorship bias distorts our perception of reality. Being aware of it is crucial, especially when making decisions based on success stories, whether in business or investments. Remember, for every winner, there are many others who didn't make the headlines. So the next time you're chasing success, keep in mind that the full story includes those who stumbled along the way. Number 5, sunk cost fallacy. Ever found yourself pouring more money into a failing venture just because you've invested so much already? That's the sunk cost fallacy at play. Picture this: you've spent thousands on a project and it's not going well. Instead of cutting your losses, you double down, driven by the fear of losing what you've invested. The sunk cost fallacy clouds our judgment, making us prioritize past investments over present and future risks. In simpler terms, it's like finishing a bad movie just because you've already paid for the ticket. Admitting a mistake and moving on is often the best strategy, yet this fallacy urges us to throw good money after bad. Being aware of the sunk cost fallacy empowers us to make decisions based on the current situation, not past investments. Next time you feel the urge to continue down a failing path, remember, cutting losses is not a defeat but a wise move towards a better financial future. Cognitive biases impacting financial decisions. Now that we've uncovered the intricacies of cognitive biases, let's explore their profound impact on our financial choices. Regardless of our financial knowledge, we often become our own adversaries, swayed by short-term desires and incomplete information. These mental shortcuts, while helpful in simplifying complex decisions, can lead us astray if left unchecked. Picture this: you're at a financial crossroads, armed with knowledge, but susceptible to biases. Recognition is the first step towards sound decision-making. Our minds, wired for quick judgments, don't always prioritize reason and long-term thinking. Understanding these cognitive biases grants us the power to resist their influence, fostering informed and responsible choices. In conclusion, navigating the complex world of finance requires not only knowledge, but also awareness of our cognitive biases. By acknowledging these mental shortcuts, we can empower ourselves to make better financial decisions. So the next time you find yourself at a financial crossroads, remember to pause, reflect, and steer clear of the common pitfalls that may lead you astray. Thank you for joining us today on this insightful journey into understanding why we make bad financial choices. If you found this video helpful, don't forget to like, share, and subscribe for more engaging content. Until next time, stay financially savvy.